All right, welcome everybody. Tonight, I appreciate you being here. Tonight we are doing a very special program. Steve Boone is the Pharmacy Insurance Director for Heffernan Insurance Brokers, and he's going to be really hosting this webinar tonight. But over the last 12 months, I have watched Steve help not only me in my stores, but a number of other pharmacy owners improve their coverage while saving thousands of dollars a year in premium. And I'll tell you, when I bought the first store a few years ago and I asked Jerry what are we going to do about insurance, he just said Pharmacists Mutual is what he does. And so we did it. And I think it's kind of become the standard in the industry. And what we have found over the years, I've been doing these over the year with these board of directors, and people have been going to Steve. It's in the high 90s, if it isn't 100%, of how he's been able to not only save people money, but get them coverage in areas they didn't know they didn't have coverage in, and in areas where they did have coverage, but it was weak and they didn't know it. He was able to fortify their policies and save them money. So that's why I think this is a very important webinar to do. Steve has over 30 years of commercial insurance experience, and he represents, Heffernan is one of the largest independently owned insurance agencies in the country. I think they're number 13 if I recall correctly. Steve is leading the pharmacy vertical. He's reviewed hundreds of pharmacy insurance plans, and he's, like I said, he's been able to save people a ton of money, and with margins and everything shrinking the way that it has, one of our members you're going to hear from tonight, he was able to save $48,000 in premiums. He's a multi-store owner. But folks, that's not low-hanging fruit. That's fruit that is on the ground that if you don't pick it up, it's going to go bad on you, in the sense that when you pay your insurance and the term expires, you've lost that money and you can't recoup it. So this is a great opportunity to pick up some money very easily just by tightening up your expenses. So without any further ado, and with my limited voice capabilities, Steve, I'm going to turn it over to you. You can introduce your team and it's all yours.
And welcome everybody to the Pharmacy Insurance webinar. My name is Steve Boone. I am the Pharmacy Insurance Director for Heffernan Insurance Brokers. I've been a commercial insurance broker for over 30 years, and most of those years I owned my own agency as an independent contractor, so I know firsthand the responsibilities of owning a business, making payroll, watching your expenses, making sure everything is compliant. Now I'm working for Heffernan Insurance Brokers, and I'll tell you a little bit about them. Heffernan was established in 1988. We are an independently owned insurance agency right now. We have over 400 employees, and we have a dedicated team devoted to the independent pharmacy niche practice. We have our headquarters in California, but we've got offices in Missouri and New York, Oregon. We are currently an employee-owned agency, so everybody at Heffernan has a stake in the business. Right now, we're ranked the top 16th as far as the privately owned and operated brokerages. We've got a lot of awards that we've won. We do give back quite a bit to the community. One year we gave back over 20% of our profits, mostly going to nonprofit organizations. The thing that really sets Heffernan apart in our pharmacy program is we do nothing but pharmacies. And so for the last 14 months, I've spent 100% of my time talking to pharmacy owners, pharmacy partners, pharmacy staff, pharmacy CPAs, all with the hope of improving your insurance programs. Now, during these conversations, I was really shocked to find out that most pharmacy owners didn't think that they had really many options. and they kind of felt like what they had is what they were stuck with, and if something changes, there was not much that they could do. After reviewing hundreds of policies, we found that the majority of pharmacy owners were really overpaying for their insurance and getting lesser coverage. And really, nobody likes paying more and getting less. That's really bad. But the worst thing we found out is that because a lot of these policies were not set up correctly, you could really end up paying out of your pocket for a claim, and claims that could cost you well over $100,000 and possibly even, cause problems with your pharmacy business. So here's kind of what we learned. 50% of the people we've worked with have Pharmacists Mutual for their insurance. 25% of the pharmacy owners we talked to have what we call a business owner's policy with a brand name carrier. Could be a State Farm, State Auto, Liberty Mutual, CNA, Auto Owners, Foremost. All of these business owners policies, they have professional liability included in the coverage. And so if you're in this group, your broker or your agent actually has put you in the right spot. Each one of these carriers does have its pros and cons with coverages and premiums, but the fact that you have a business owner package policy with professional liability is really the place that you want to be. Now, the last 25% of the owners we talked with, they have coverage in what is called the excess and surplus lines market. I like to compare that to high-risk auto insurance. So everybody knows that you don't really want to have high-risk auto insurance because obviously the premiums are high and the coverage is not as good. And so, you have to ask yourself, how do I know if I'm in a high-risk insurance market? Well, first of all, the company that is insuring your pharmacy is most likely not a brand name that you would recognize. Companies in this market are companies like Evanston Insurance, Attain, Hiscox, Lloyd's, Beasley. Basically, they're not name brand companies. Another way to know if you're in a high-risk insurance market is if you pay your premiums directly to the broker or agency, or maybe you have a premium finance agreement with a finance company and you're paying installment payments. Chances are, if you are seeing state taxes or surplus line fees on your invoice, you're paying high-risk pharmacy insurance premiums. Also, if you've had many claims, or if you've been canceled or non-renewed, or if you have a large or do a large percentage of compounding, maybe some of that is sterile, or possibly your sales revenues are high, maybe 20 to 25 million or above, or maybe your broker doesn't have access to the right markets. All of those reasons means that you have landed your pharmacy insurance in a surplus lines market. Really, your goal and what we try to do is to get you out of surplus lines as soon as possible and into a standard market that offers the business owners with the professional liability included. So if we take these three markets, I'll explain to you how the coverage can differ between the carriers and how you know if you're paying too much or not. So market one is Pharmacists Mutual. That's 50% of the people that we've talked with. Now, Pharmacists Mutual is an A-rated company. They are an admitted carrier, so they're not surplus lines. Pharmacists Mutual has about $100 million in premium. I know it sounds like a lot, but it's really an extremely low number for a brand name carrier. They've got about 250 employees, and the agents for Pharmacists Mutual are what they call captive employees. So they are employees of Pharmacists Mutual. They're not independent agents. And really the important difference there is they cannot offer coverages outside of Pharmacists Mutual. So they're kind of pretty much stuck with that. Now, there's some pros and cons of Pharmacists Mutual. The pros, the fact that they're actually offering insurance is a good thing. They support the Pharmacy Association, and they are dedicated to pharmacy owners, so that's good. Now, the cons with Pharmacists Mutual if you purchase or if you have different locations or if you have several different entities, what they do is they make you buy a separate policy for every location and entity that you own. So if you own 4 pharmacies, let's say 2 buildings, and you have 4 LLCs, you're going to need to buy 4 different policies from Pharmacists Mutual. Each one of these policies have expenses, they pay commission on them, and really the bottom line is it's hard to administer this many policies, and it's an expensive way to do it. So that's one con. If you have automation, if you use robots or pill dispensers, and you're with Pharmacists Mutual, they require that you buy a separate policy for that equipment. I've seen premiums range anywhere from $400 to $1,600 a year per machine. That's an extremely expensive way to insure that property, and it's really not necessary. And when you compare coverages with Pharmacists Mutual, we've noticed by far their policies have more limitations, restrictions, and exclusions than anybody else. And we've also learned that every year when your policy renews, you'll get pages of changes to these limitations, restrictions, or exclusions. So it's really hard to keep up with all that, and most people don't like the fact that they've got to go through that and read the fine print. So I would say that's not really the best thing to do. Many of these policies that they sell to will have sub-limits, things like employee dishonesty, spoilage, theft of money, coverage for signs, data breach, employment practice. Really the bottom line is all those sub-limits that we reviewed, the majority of them have what we would call on the lower side of limits, or they're not covered at all. So that was kind of a big red flag when we looked through that. The other thing we found out from many of you during our interviews is every year you're going to get a renewal questionnaire from Pharmacists Mutual. Usually the agent sends you an email, it directs you to a link, and that link, basically there's pages of questionnaires that you need to fill out and sign, which ends up becoming a legal document. So every year you've got to disclose exactly what you're doing, and what concerns me is if there is a claim and it's not disclosed on this questionnaire, you know, what happens? Does it hold up the claim? Could they void the claim? It really becomes something that if you don't have to sign documents every year, it'd probably be better for you. Now, in the second group, we talked about this is the business owner's policy. This has the professional liability included. This is going to be your travelers, your Allied, your Safeco. These policies are good, and really what comes down to the competition is finding better coverages at lower premiums. So we found that many of the people in the second market, they actually were paying sometimes 15 to 20% higher than what we were quoting. So our goal is to always save you money, but more importantly, always improve on your coverage. So if you're in that second group of the brand name carriers with the business owner's policies, it still is worth your while to have it reviewed because we can find savings and also maybe close some gaps in coverage. Now this last segment, where we saw at least 25% in this segment, is called the surplus lines segment. It's basically the high risk of pharmacy insurance. When we quote against this group, we're saving anywhere from 25 to 50%. You'll get coverages that are much broader. Your deductibles will be lower or they'll go away. And really, if you think that you're in a high risk or surplus lines group, you really need to pull out your policies and let somebody look them over, because unless there's a reason for claims or maybe volume or something of that nature, you really are not in the best spot. You're paying too much, and really, if you could get out of it, you'd be better off. So with the different owners that we quoted this last 12 months, about 80% of everyone ends up switching over to us. And the reason they switch, it's simply they like the savings, they like the broader coverage, and they like to get in with an independent agent that has a dedicated team that does nothing but pharmacy insurance. So the three things that we always want to do is to lower your premium, better your coverage, and to make sure that you have good service and a single point of contact if you ever have questions. Now, I'd like to talk about two areas of coverage that we're finding almost universally where there is no coverage for pharmacy owners. And the first one is called employment practice liability insurance. And what that is, and I'm going to have Mr. Lance Sunders come on here. Lance is a wholesale insurance broker. He works for the wholesale insurance agency called RT Specialty. And what Lance can do, he's an expert in helping you form a plan that can take care of any type of wrongful discrimination or defense of employment practices. So, Lance, if you're there, if you could tell us a little bit about what you do.
Sure, thank you. I've been doing exclusively product lines in the executive liability arena for about 20 years now, so employment practices would be one of many. It could be directors and officers type liability, fiduciary, crime-related coverages, but for smaller companies, for private companies, these contracts or policies are generally set up on a modular format where you can select one or a number of different coverage sections, but a lot of times the driver of the purchase for these products is employment practices. And the key to remember about why this product is important is any type of employment decision, from who you're hiring, who you're promoting, who you're firing, or potentially letting go or downsizing. Anytime you make any of those decisions, you've got a potential for liability. And it's not only the manner of which you go about things, because clearly if the steps aren't done right, then you can create a situation, but you can do everything right and you can still get sued, right? You can have somebody that is upset about the decisions that were made. I should have been hired, I was looked over, I didn't get the promotion, so on. Any of those types of events can create potential for liability. We see a lot of cases that are brought by and through the EEOC, in which an individual brings something to the EEOC of which they then investigate, although I will tell you I see nearly as many claims, if you will, that are more of your traditional variety involving some sort of demand by a plaintiff's attorney representing some sort of a single plaintiff. What kind of exposures do we need to worry about here? I'm going to call it the big three, if you will. Harassment, discrimination, and wrongful termination are kind of the big three. That's where the bulk of the claims that we see and situations are going to rise from some form of these three, and there's so many different flavors and varieties of these protected classes, if you will, age, race, sex, religion. So there's a lot of different areas of which can trigger liability through these. You've obviously got retaliation aspects and whistleblower things to worry about, and other various workplace torts that are here on the slide mentioned. One of the other things that's not on there, something I'll just call a hostile work environment. I've had way too many claims of late where somebody gets released after a long period of time and they're upset, or maybe they can't find another job, and then all of a sudden 6 months later they suddenly remember they were subject to a hostile work environment or some other situation that they are now uncomfortable with. And a lot of the claims that you're going to see are actions involving one employee to another employee. It could be a manager to another employee. The other piece that's become fairly big here in the last half a dozen years or so is what I'll call third-party liability. It's harassment and discrimination involving outside individuals. So it's interaction between you and your employees with something as simple as a customer or maybe a UPS delivery person. So maybe they feel that certain aspects of an exchange were inappropriate, or maybe they felt discriminated against, whatever it might be. But in actions involving third parties that enter your premises or even those outside your premises where your employees are interacting with those third parties can definitely cause some issues. The other area where we've been seeing a lot of issues is what we like to call wage and hour type claims. And this is employees that are paid on an hourly basis coming back and saying, I was classified as exempt and I should have been non-exempt. I wasn't getting state-mandated breaks every 2 hours or whatever it may be. So therefore, I've been working 60 hours a week and I should have got overtime, things like that. These claims are such that typical settlements for these types of claims aren't covered, but you can definitely get, in most states and cases, at least defense cost coverage for these. And a lot of times the defense cost coverage is every bit as equal, if not more important, than any type of indemnity coverage for it, because many times these cases don't have a lot of real factual elements, so you just need something to fight it. I have some statistics on the third slide there about certain of the EEOC trends that we've been seeing. Obviously, you can see the harassment, discrimination, various types of ADA violations that are listed in there. I'm not going to go through this in detail, but I wanted to give you a flavor for what's out there. Some of the takeaways on this is the numbers have been pushing 100,000 a year in these types of actions, and that's just with the ones that are involving the EEOC. This is not representative of anything that might be an individual trying to pursue this on their own or somebody who enlists a plaintiff's attorney to represent them. What type of costs are involved? It's really easy and very typical to see defense cost rates for attorneys to run $250 to $500 an hour, and I've seen stuff well in excess of that depending on the venue or jurisdiction. I've got one piece of information on there from Chubb's most recent private company survey that said the average cost of these types of events is over $70,000. So there's some big dollars in play. One of the other shocking statistics that I saw as I was looking through this, some of the materials, was that since June of 2009, there's been 135 claims that have settled for over $2 million. Did not think that that number would be that high. And clearly these are a lot of times involving companies that may be bigger or may have some multiple plaintiff issues, but it also could be involving a situation where the events are just egregious over a long period of time. So very common for what I see. Even a claim that doesn't have a lot of factual basis is probably going to take $10,000 to $15,000 to get it dismissed. And if it doesn't survive, or excuse me, if it makes it through the motion to dismiss, then you're talking about numbers well in excess of that. So the good thing about when I was talking about rate per hour from a defense cost standpoint, many of these contracts, the carriers that are defending them on your behalf do so much of this that they've got pre-negotiated rates with a lot of the top firms in most states. So rather than coming in off the street and getting charged $500 or $600 an hour, you might get it for $250 because it's part of their panel rates. So a lot of benefit to having this. It's hopefully not something you'd want to see used, but at the same token, it can also be something that generally is going to be excluded under almost any other type of insurance product. So to have an unexpected claim and take a hit that might be $50,000 or $100,000 and potentially even more could be something that we're obviously trying to avoid on your behalf. So, Steve, that's kind of my quick summary.
Thank you, Lance. Excellent points, and I'll tell you, $70,000 out of pocket to pay for a nuisance claim because somebody was disgruntled is really hard to swallow. So we have seen almost everybody without this coverage, and it's something that we can offer or you can buy on the market, but I would definitely look at your policy to make sure if you've got that kind of coverage. The other area where we saw really open for a lot of out-of-pocket expense is the data compromise or cyber breach, as they call it. And on the call today, we have Kevin Sneed. Kevin owns U.S. Pro Insurance Services. He's really considered America's cyber expert, and we use him quite a bit, but I'm going to bring Kevin on and let him talk to you about what he's seeing with the cyber events, and he'll give you some examples on how it could affect you. Kevin?
Hey, thanks, Steve and Lance. That was good stuff. Thanks so much. Listen, I'm going to talk to you very quickly about cyber in 3 short, real quick overviews. The first will be how it happens. The second will be what is the imminent center of the cyber universe. And the third will be what insurance solutions are available to you to be able to rectify this problem. And that's a lot to get in 10 minutes, but we're going to move pretty quick. And hopefully you guys will come away enlightened and wanting to know more. And so here's how it goes. There's 3 main exposures under a cyber policy. Cyber really is a package insurance policy similar to your fire and your GL, but it really revolves around the digital assets of a third party's personal confidential information, which is in your care, custody, and control. So to put that into a simplest measure for a pharmacist, it's your customers, the people with whom you serve in your community. So obviously, you want to keep that information protected, not only because of the implications that you can face with HIPAA fines and penalties, but more for your reputation and your brand, and to avoid it being damaged through the cost and the measures that go along with the data breach. So the 3 areas of those exposures that we're going to talk about are media liability. The second one is the network security exposures that you might have, and the third would be privacy liability compromises. Those are the 3 main areas of legal liability that you face as a result of federal, state, local laws, both governing protected health information, which is the HIPAA stuff, as well as personally identifiable information, which happens to be the Graham-Leach-Billy and the state federal privacy law stuff. So under the media liability exposure, there's 2 really main impetuses that drive these claims. The first is deceptive advertising, unfair trade, and libel slander type actions. And the second could be online comments. Now, as we talk later in this piece, I'm going to give you 5 real-life claim examples that apply to these 3 various exposures and the amazing amount of peripheral costs that come as a result of one single event. And it's pretty eye-opening. The second is network security exposures. These happen a lot of different ways. Only 18% of all data breaches come through a network security breach. So although hackers are causing damage, it's not the #1 way it's going on. Unauthorized acts to or use of causes severe losses for anybody who doesn't even know what's going on. So efficient harming attempt that gains somebody unauthorized access to or use of your systems, that can be detrimental to you in the long run. Those are the primary causes by the network extortion piece, but they're driven by unintentional employee negligence, and that's the one thing that people don't understand. 88% of all these breaches and events occur because of unintentional employee negligence, and that would be your own employees doing things they, most cases, don't even know that they're doing. Other big exposures are business interruption and data restoration expenses that are created as a result of denial of service or breach events. Rogue employees, which we're also going to talk about in a second, is another leading cause of a network security breach. Now, on the flip side, there's a privacy liability compromise. So a privacy compromise, which is the exposure of data in your care, custody, control, that can happen from a network security breach. But the interesting thought is it's more likely to occur simply because of a non-hacking event. Most privacy breaches happen because of employee negligence. They happen in many ways, but the leading cause is loss of stolen mobile devices. So when you have stuff that's on your cell phone, your tablet, your laptop, a hard drive, an external thumb drive, any of those things, it is really important that that information is always encrypted. But in most cases, people don't know this, that information is not encrypted and sits in an unencrypted format, which makes it very easy for these thieves to go after and get. So we tell people it's a must to encrypt, but yet you have to understand that even in those cases, you're still going to have events because you'll have improper disposal. People throw things away into the trash. They shouldn't throw away. They should be shredding. They send in copy machines without clearing hard drives when they get a new copy machine. Or one of my favorite ones is inadvertent disclosure, which I can attest. I just talked to somebody yesterday about a claim like this, where they inadvertently put somebody's information out unwittingly and unwillingly, knowing that it's out there, and it causes them severe expenses and notification costs and other things that go along with the breach response. So that's how it happens. The center of it is the record. we ask ourselves, what does a record mean? A record is a unique set of someone's personal confidential information. So even if you had multiple sets of one customer, it still only quantifies as one record because it's one uniquely identifiable information record. PCI comes in two forms. The first is personally identifiable information. That's the simple stuff. Name, address, social security number, credit card number, anything that might be associated personally to your customer. As little as someone's name and email address is enough by most privacy laws to constitute a data breach. So you could be responsible for having notification costs and expenses just from a breach of a mailing list. That's an interesting piece that people are unaware of. Third-party data in your possession is the property of another person. So allowing that property to become on fire or burned by being hacked is a liability that you face. It's regulated by Gramm-Leach-Billy and most state laws, so you have to be very, very careful that you're always keeping this stuff safe. The problem is that you have employees, and employees inadvertently do things to expose that information. So what's the implication for you when it occurs? When it occurs, notification of the breach is required in almost every case. These do vary state by state, so if you're a pharmacist, chances are you could be doing multiple state notifications, especially when somebody who's in town on vacation orders from your pharmacy, and now you have multiple incidents of notification. You have to hire lawyers. They have to navigate these requirements. Letters need to be sent. Postage needs to be put on them. Expensive people need to come in and fix the problem. They need to shut it down. It's like putting your finger in the dam. On top of all of these things, civil liability and potential damage awards in courts can occur. So in some cases, a regulatory investigation may be launched, which we're going to find out in just a second. And you'll have threats of fine or penalties, especially for pharmacies, because HIP is exposed. So consider this and consider some quick numbers. 88% of all the events that occur in cyber liability insurance are caused by unintentional negligence of your own employees. The average cost per record to respond to a breach is $180. So if you have 1,000 customers, you're looking at $180,000. If you have 10,000 customers, $1.8 million. That's your average. It's a good way for you to quantify what the exposure is to you and your business. The average claim for a data breach event, I've rounded to 180. It's really $188,242. An interesting new number that was released by one of our carriers says that 67% of all businesses will go out of business within 6 months of a security breach that results in a data compromise. So it is a really big problem. And then the last number is 512. There was 500 million records breached in the United States in the last 12 months. Last but not least, there's a lot of things you can do to mitigate cyber. I always say to people there's 4 choices you have. You can accept it. If you accept it, you self-insure it. But at $188,242 on the average claim, it's all but impossible to put away enough money to self-insure it. So that's not really an option. I could say that you could avoid it, and if you avoid it, I already told you 88% of all your losses come from employees. So you can't really fire everybody. It's not avoidable. So you have 2 things left. You can either mitigate it or transfer it. Mitigation is a great thing. You can hire external services to do data recovery systems. You can do all of this off-site data storage stuff so that you have backups that you can put in place should something be wiped. Those are all different things that you can put in as what I would call system solutions to be able to mitigate how often or how much an event might cost you. But you can't avoid it. So the last thing you really have, and it should be in components with other mitigation factors, is insurance. But insurance is a tricky business, though, because there's a lot of things you can do with insurance in cyber these days, but all of them are very, very different. And the first thing I always have to say to people is never package your insurance. So what do I mean by that? Never take a cyber exposure and package it under a package policy. Don't take a cyber exposure and package it into a D&O, EPL fiduciary policy. There's a number of reasons, the biggest reason being the coverage is not going to be the same. But another reason is it could skew not only the exposure mods under your general liability or your package policy, but even the loss ratios under your D&O form. But more so, it can make them ineligible for the admitted marketplace because the losses could be so high. That's how bad a cyber loss really can be. So I advocate there's two other ways to do it. A third-party plus policy. That's when you buy a policy that covers you for those 3 third-party coverages we talked about and gives you a little bit of coverage for first-party expenses, which is the meat and potato of that $188,000 claim. The last way, and the way that I advocate to all of our customers, is a third-party, first-party complete. What does that mean? That means that I'm going to get coverage for that media liability stuff, that network security stuff, and that privacy compromise stuff. But more importantly, I'm going to get coverage for those really important property coverages that I talked about when we first opened this coverage part, like business interruption and data restoration and all the forensic costs and legal costs and the notification costs, crisis management expenses, customer support and credit monitoring expenses, all of those costs. That comes with that third-party, first-party complete. And quite interestingly, it's really not a lot more money than going the other route. In fact, so insignificant that to not have it can cost you tens, if not hundreds of thousands of dollars on the back end of your claim and save you $600-800 on the front end. It's just not worth it. So here's the last thing I'm going to go through, then I'll throw some real quick claim examples at you, and we'll be done. The need to know. Cyber insurance is a package policy. It's a property GL combo policy for digital property of third parties in your care, number one. Number two, it's very similar to fire insurance. The average property fire is $30,000. The average cyber claim is $188,000. The big difference between the two is the time from ignition to alarm. So it takes just minutes for me to be aware that there's a fire burning in my building. But it can take me 4 months minimum to find out that I got a fire burning in the property inside my computers. That's what's really important to understand. So when you have a fire and it is discovered, you want to make sure that you come back with a fire department response. In order to do that, you need to have a policy that's going to be able to give you a combination of risk management services, which is similar to installing smoke alarms in the building and sprinklers, and they also want claims management service, which is like having your building connected to a fire department who's going to come in, put the fire out, and make everything better. That's what we want to sell. That's what you want to buy, because then that's what we call a complete cyber program. Now, real quick, I think it's really important to understand this. There's 5 claims I'm going to give you, and they can happen to anybody. And although I have lists and lists of claims, these are really good examples of how a small business or even a medium business, that's a pharmacy, can face some exponential damages way beyond these averages I've even indicated. The first would be a situation where a piece of lost or stolen mobile device, it was a lost laptop. So a laptop was lost, and it contained sensitive financial information of customers. So what happens? Because there's financial information implicated here, Gramlich-Philly lost an investigation. So we have a bunch of things happening. We have a privacy compromise, which is a third-party claim, and then we have the defense and the indemnity expenses that go along with it, plus a regulatory proceeding and a potential penalty. The total defense only on this open claim has already exceeded $700,000. A second issue would be a situation where you allow people to be able to log into your pharmacy to refill their orders. Your system goes down for a period of 3 days, and they cannot refill their orders. So during this time period of downness, because you had a business interruption due to a denial of service attack or some type of network extortion event that occurred, not making your system available, they sue you because they can't fill their medicines, they can't make their transactions, pay their bills, whatever it might be. Customers sued this company for more than $750,000 in the damages that it caused for just 3 days offline. Another one was where a small business hired a computer software guy to come in and update and upgrade their systems. They didn't like the job he was doing. They hired him for incompetence. So what did he do? He hacked into their system and deleted their entire system and all of their files. Here's a deal where they have to pay over $95,000 to restore the data. That's a pure property claim, just to restore their data to whole because of a rogue employee. Another one of my favorite ones, is they download a malicious virus into their computer through an email they received by an employee from a credible source, not knowing it has this attachment. It attaches itself to its email system and transmits a malicious virus out to 1,500 email addresses located in their email system. 50 of those 1,500 people open up this virus and it wipes out their computers. This cost $3.1 million in damages to repair the cost on this. And last but not least, you know, Lance talks a lot about EPL and about termination of employees and be careful about what you say and sexual harassment and discrimination and all these things. Well, this works for cyber as well. Under media liability coverage, it's basically giving you coverage for a personal injury torts that you violate to a third party, meaning you cannot defame people's character on your websites or in your electronic and printed material. You got to keep their reputation whole. So in this case, a company is sued by an ex-employee for their own breach of privacy when comments about that ex-employee were circulated over the internet. They had to pay this person $400,000 for a simple remark made on the internet. So I cannot emphasize enough, cyber is so much more than some hacker from China or Europe or Russia lurking around the corner trying to steal your data and run rogue credit cards. It really is, the root of the problem is really your own employees, and the best way to mitigate that is a strong system of internal controls complemented by a strong insurance program that will act as a breach response weapon should you be under attack. And that is it. Thanks for your time.
Kevin, thank you. Wow, I tell you, every time I listen to you, you have more examples. And these are real life stories. So the money out of pocket is significant and the exposure's there. So let's just recap kind of where we came from for tonight. So we reviewed hundreds of policies. Lots of them were PDS members. We found that the majority of pharmacy owners were with Pharmacists Mutual. About 50% were either in what we call standard markets or the surplus lines markets. Bottom line is everybody got their insurance reviewed. We were able to find ways to help save money, and we discovered many areas where you're uninsured. So really the next question is, you know, what's the next step? So if a person was interested in getting an insurance review and they wanted to use Heffernan, on this slide you can see we've got a website set up. There's a short questionnaire there. You would send the questionnaire in and our staff would begin the process of doing the review. Or you can call me directly or email me. Like I said, I do nothing but pharmacy insurance all day long. And we really have a staff and carrier connections here that will give you some options. And the bottom line is really that. You decide where you want to have your insurance. But we feel if we can give you some options and give you some heads up on some areas where you might be exposed to out-of-pocket expenses, then you're better off. And really that's the bottom line here, is just making sure you're more profitable and your business is delivering what it promises.